This is a facility for the Fed to provide dollars when dollars are scarce. We saw pretty heavy usage 2 days ago, 30.5 billion, indicating, obviously, that the banking system was short on cash. The Fed is printing money out of thin air, printing bank reserves to then purchase T-bills.
When the Fed loses control of the repo market and repo rates, it's a liquidity issue. Chances are they're going to need to up the amount of RMPs that they're doing. Bitcoin tends to be a pretty good barometer for liquidity, and ultimately over time, it winds up correcting to the upside and reflecting that pretty well.
We know what their response is to any hint of economic weakness, to any hint of financial stress. It's to print money.
C3, okay, a millionaire. I'm a young money millionaire.
Good morning, good afternoon, and good evening, everyone, and welcome to the Daily Stack Thursdays Macro Edition. Today, we are so stoked to be on with both Infra and macro heavyweight Joe Consorti. Guys, thanks so much for joining us. Appreciate you hopping on. How are we doing this Thursday?
Doing great. Macro heavyweight. I appreciate that. I've never been called that before. I would say Infra is definitely a macro heavyweight, but myself,
okay.
I don't
macro
know. Either way,
thanks
for having me on.
We can give the gold medal to Infra and the silver medal to you, and you can claim the gold medal whether it be real estate or Bitcoin lending on your real estate. How about we settle there?
Fantastic. It's good for me.
Yeah, good to be here.
How you doing? How's the macro landscape shaping up this week? We have some amazing topics to dive into. We've got the Fed liquidity, which everyone is talking about. We've got 3 different numbers circulating. We have 208 billion, we have 30 billion, we have 8 billion. Everyone's and their mom is trying to figure out where the hell is this liquidity coming from? What's driving it? So maybe let's start there before we hop into AI and Bitcoin versus gold. Let's start off with the question that everybody wants to know. If you are joining us on Twitter, on YouTube, drop us a comment, drop us a follow, a like, whatever it is. Give the show some love. We would greatly appreciate it. But with that being said, Info, let's dive straight in.
So there's a lot to unpack here, but here we're looking at the standing repo facility. This is a facility for the Fed to provide dollars when dollars are scarce. And we saw pretty heavy usage 2 days ago on the 17th, 30.5 billion. That is the third highest reading going all the way back to the summer of 2020, indicating, obviously, that the banking system was short on cash. Now, it's not month end, not quarter end, not tax deadline. There is kind of no real logical conclusion to come to as to why liquidity would be so scarce. I would point to the fact that we are having pretty large auctions for these T-bill auctions. So here, for example, we can see the 52-week bill auction. We sold 50 billion of those. 3-month bills, we sold 4.1 billion. 89 billion. The Fed bought 4.1 billion. And then the 6-month, we sold 77 billion. This was all in a single day. And so you total that up, that's almost $250 billion worth of debt that was issued by the Treasury Department. That debt had to be purchased. Now, the number we were talking about before, that is I think Seeking Alpha, that's in regard to settlement date, and that you can find on the auction result page. You can see the date that it's going to actually settle. But yeah, there's definitely a shortage of liquidity. Again, this is due to the fact that the Fed's been engaged in quantitative tightening, just as QE is positive for bank reserves and liquidity because the Fed is printing money. Well, quantitative tightening is the opposite. It is destroying money. Not only that, but the reverse repo has been dwindling down, basically empty right now, under $1 billion. And not only that, but the Treasury general account had to get built up, in Q3, Q4 of last year, which was a drain of liquidity. This about 700, 800 billion was removed and put in a government checking account, right? That's why the TGA, that's why that matters. And that's why SOFR spreads are inversely correlated to bank reserves. And so there clearly was a shortage of liquidity in Q3, Q4 of last year. The Fed were quite worried about it. So you had Lisa Cook warning about the basis trade. And of course, that base trade responsible for absorbing almost half of all the debt that has been issued. Almost half of it was purchased by hedge funds engaged in this basis trade, 100-to-1 leverage, basically risk-free, trying to capture a small basis between Treasury futures and cash Treasuries. So that trade, the basis trade, is financed in the repo market with, of course, SOFR, which was starting to become starting to dislocate in terms of its rate. For some reason, TradingView is totally freezing up on me, but that's why SOFR matters. That's where the basis trade is financed, and we saw, of course, SOFR spreads were widening quite dramatically. Potentially, could cause issues, an unwind of the basis trade, which would require a forced selling of cash Treasuries, meaning lower Treasury price, higher yield. And so that's why the Fed, was engaged or announced that they would start to engage in these reserve management purchases. That is where the Fed is printing money out of thin air, printing bank reserves to then purchase T-bills. And so that is the reserve management purchases that have been going on. We can see 2 days ago, $8 billion was printed for T-bills. And so this is what the reserve.
Just pause there for a second. So we have the par value of 50 billion. So the 8 billion is the net cash injected. Is probably the best way to think about it. Is that accurate?
Yeah, you look here at accepted. Yeah, I would just ignore that. There's no point.
Okay, and this is all publicly available data that the Fed puts out on their website. How does this 8 billion compare to, what was the last time they did this, and how big or small is this in relative terms? Because when I look at these numbers and I hear the Fed, I hear 8 billion, 30 billion, a lot of this is all lost in context, because what I'm really interested in is how impactful is that 8 billion, and what is the net change that could lead to based on what happened in the past.
Yeah, so 210 was the one before that. That was 8.3 billion. And then we see another one, 24, that was 8.3 billion. So, they're under 10 billion. If we go back to the auction, these T-bill auction results, you can see it's, pretty small relative share of the overall auction. For example, this one, what is that? 1%? 2%? I'm bad with math.
Yeah,
3%, probably 3.5%, maybe of the total auction. So 8 billion is really not very much. I mean, we measure bank reserves in the trillions, right? So it's 2-point-something trillion when it comes to bank reserves. So yeah, it's they'll probably have to. My guess, if we continue to see SOFR kind of starting to widen, it's just 2 basis points below the Fed's upper bound right now. If we continue to see SOFR start to approach or even break that upper bound, which is 3.75 right now, that's a discount window rate and the standing repo interest rate. If we see SOFR start to kind of hang up there and not come down or even break through that upper bound, that, of course, means the Fed is losing control over the most important price in the modern financial system, which is the price of $1, then I think that they'll take it just as seriously. I mean, it wasn't just Lisa Cook that was worried about SOFR and the repo market. It was the former SOMA manager, so the Fed balance sheet, right? Who is the guy that is actually responsible for managing that $6.5 trillion balance sheet? That is called the SOMA manager. Well, the former SOMA manager, the current SOMA manager, and Lisa Cook, as well as Jerome Powell, and there was another Fed official. There was 4 or 5 of these Fed officials, really, really significant ones too. Talking the Fed chair, the SOMA manager, not just some random Fed official. There were a number of statements kind of, Q3, Q4 of last year that they were getting quite concerned. And that's why the RMP started. So, I think the easiest way to think about it is if they were concerned and willing to start RMPs over what was going on in the repo market, then if those same conditions from Q3, Q4 start to become replicated, we start to see the same thing now. What that means is they're going to be pretty willing to increase the size of the RMPs, in my opinion.
Gotcha, Joe. I want to give you just a chance to weigh in because we covered a lot of ground in a short period of time.
For sure. Yeah. So one thing I'll do is I'll kind of draw the comparison. And this is a really good chart that Infra has up on screen here. I'll draw the comparison to what's happening now to September of 2019, when we had a cash shortage in the repo market and the Fed began expanding its balance sheet at that point in time. Now, when that happened, that was in response to a cash shortage in the repo market. It was in response to a crisis. This time it's a little bit different. It's coming out in advance of a potential liquidity crunch in markets. And so, these operations are a little bit different. The cadence at which they're purchasing these treasuries are a little bit different. Right now, there's a $40 billion monthly approximate cadence and doing about $8 billion per week. They're coming just a little bit shy of that. But even still, we saw back all the way in 2019 that wasn't enough to prevent markets from blowing up in one way or another. And eventually this led to outright QE just 5-6 months later, where the Fed massively expanded its balance sheet. Obviously, that was due to an exogenous shock because of COVID. But the reality is that the Fed hasn't been able to have prolonged periods of this liquidity drought in markets. This is just the tip of the iceberg, in my view. The Fed's total assets, if you take a look at their balance sheet, have increased from about $6.5 trillion to $6.6 trillion, $6.62 trillion. So they're expanding at a decent clip, roughly in line with GDP. But the reality is that we haven't been able to go a sustained period of time, only marginally increasing the balance sheet when liquidity is tight. I'd wager that these purchases are going to increase in size in order to stave off a potential crisis.
I mean, just for the layman, Infra, the chart that you have up is fascinating because how often in the chart in the last, let's say, decade plus, has that number, that top line flattened and started to decrease for a prolonged period of time? And every time it has, we've just seen a massive spike higher. And we've kind of at that plateau now where it feels like, I mean, isn't it bound to correct to the upside?
Oh, yeah, for sure. Their response is always going to be to print money and expand the balance sheet. I think anyone worried about Kevin Warsh and prior comments he's made about shrinking the balance sheet, I think that's all totally, misguided. I don't think that they're going to shrink the balance sheet at all. I think that's going to continue to grow, like Joe said, kind of in line with GDP. That is kind of the new motto, the new school of thought. The balance sheet should grow in line with GDP. Every time we've had quantitative tightening, we've seen what happens, which, Joe is mentioning the 2019 repo crisis, where SOFR went like 11% above on an intraday basis, 11% above the Fed funds. So we saw what happened, right? They came in and they started QE. They started balance sheet expansion. We can see that here. And then, of course, 2020 came and they really, fired up the printer and they really printed a lot. But, immediately following the 2019 repo crisis, they started to print right away. So we know, and by the way, like they started to print again after what some people thought there was no issue. Well, if there was no issue, why are they starting to print again? There was clearly an issue. You had the former SOMA manager, current SOMA manager, Fed chair, Lisa Cook. You had a number of key Fed officials warning about what was going on with SOFR, what was going on in the repo market. And what did they do? They started to print again. If it was no big deal, then why are they printing again? Why are they all warning about it being such a big issue? It's because it was a big issue and because the basis trade is critical. They cannot let the basis trade blow up. That's half.
Let's get into that then, because that's really what that Forbes article that I think you referenced in your YouTube video was referring to, was that exactly. So that 30 trillion treasury market, these guys are trying to protect what 40% are related to that specific trade. And they're trying to protect these massive global institutions / hedge funds / entities from blowing up. Why is that so critical?
Yeah, so the Fed actually did a study that people can find here. It's called the Cross-Border Trail of Treasury Basis of the Treasury Basis Trade. And what they found here was, again, about 40% of all U.S. Treasuries issued by the government going back to 2022 had been purchased by hedge funds. And again, these funds are levered, 50 to 1, 100 to 1. insane amount of leverage to basically scrape a tiny basis between the future and the cash treasury. And the reason for that is the future has a flexibility to it. If you buy a 5-year future, you don't actually necessarily get a 5-year at expiration. So there's a bit of a kind of, it's wonky, but that's why the basis, part of the reason the basis exists is that futures contract has that kind of uncertainty premium, you can think of it, embedded in the price of it. Therefore, as you get closer to expiration, that converges and you're scraping that basis. You're levered up because, you're only talking, I don't know, 10 basis points, 20 basis points. But if you're levered 100 to 1, that 10 basis points or 20 basis points is quite a lot. And so that's the basis trade. And it's financed the government. I mean, it's financed almost half of the U.S. government. So they cannot let it blow up. And the Cayman Islands, I mean, one of the really stunning, there were a lot of stunning conclusions from this particular paper, but one of them was that the Cayman Islands is actually the largest holder of U.S. Treasury debt, the largest foreign holder of U.S. Treasury debt. They had undercounted the Cayman Islands by over $1.4 trillion.
Wow. I mean, that's wild. How did they get it so wrong?
Well, it has to do with the way that repo is classified and reported, and the data, the data reporting. Basically, this is not my area of expertise, but yeah, there were issues with the way that some of these flows and some of these positions were being reported, and so that's why the undercount was so bad. But I did a chart. I don't have it in front of me, but I did a chart showing what we thought the largest holders of U.S. Treasuries were before this report, and then what it is after. And it's like, we went from thinking Japan was the largest holder with 1.1-ish trillion to, wow, now they're like a distant second. Like the chart was really pretty wild because we undercounted the Caymans by over $1 trillion. I mean, it's stunning how much they undercounted. You wake up one day and it's like, oh, actually the largest foreign holder of U.S. Treasury debt is this tiny little island nation with I think a population of 30,000 people. And the reason, of course, it's not that their economy is so robust that they're huge holders of U.S. Treasury bonds. It's because they're a tax haven, and all these hedge funds and feeder funds. It's all in the Cayman Islands. So I think it says quite a lot about the health of the U.S. economy and the health of U.S. Treasuries when half of the treasuries that we've issued going back to 2022 have been absorbed by this basis trade. So we can see that here.
I mean, it's crazy. It's also, I mean, it's not surprising that data is misrepresented because the person compiling the data has a specific set of incentives, and I would wager that it was not necessarily to inaccurately report a lot of this, but to not count those for whatever reason would benefit the institution providing the data that they're reporting, right? I mean, it's all about the incentives at the end of the day. And regarding a small little tax haven island with 30,000 residents, it reminds me about that mysterious Joe. I don't know if you caught this on Twitter. This mysterious new holder who's the largest holder of IBIT ETFs, and no one knows who they were. And Jeff Park, I think, released a tweet about it, saying that there was a new holder of the largest IBIT holder in the US is an anonymous entity that no one has any idea about. Did you catch that?
I didn't catch it, but it's no surprise to me. Look, like the IBIT ETF has been hugely successful for BlackRock, something that they're pushing really heavily. And River actually put out a report. I'm not sure if you saw it, but individuals, the amount of Bitcoin held by individuals decreased by roughly 690,000 in the year 2025. And ETFs holding Bitcoin on behalf of their clients and institutions it increased massively, right? So it's sort of this rotation that's underway. It's no surprise to me that it's an anonymous entity being the one of the largest accumulators of IBIT. It's just a structural trend that's underway with Bitcoin, where we're seeing more institutionalization, more concentration of not just the spot Bitcoin, but spot Bitcoin ETFs held by institutions. Yeah, no, it's apparently they've got, let's see here, 13.88 million shares. Let's see. Yeah, so that's quite hefty relative to IBIT's flow. So it's I think 2.5% of IBIT shares outstanding. So absolutely
wow.
wild.
Yeah, it's always amazing when I come across articles like this, and you just think like, how the hell did they acquire so much Bitcoin or such a large stake without anyone like batting an eyelid or even noticing? Like 2.5% of their entire float is a mysterious Hong Kong entity, right? It's definitely makes you go back to the data reliability, and the questionability of that data all comes down to the incentives of the individual or the institution putting that data together. But yeah, let's jump back into liquidity, because sorry, I didn't mean to derail us there. We were talking about the Cayman entities and the underreporting there, Infra.
Yeah. I mean, we've seen the basis trade blow up before, and it's not pretty. The basis trade is a well-known to regulators and policymakers within the Fed and CFTC. I mean, you can find dozens of articles and statements and speeches given by, key policymakers and regulators about the issue of the basis trade. It's been an issue for years and years and years, and it's blown up, many times. And so it's kind of funny to me that like we all know that this is out there as a huge risk. And it's hard to kind of move past the fact that literally a bunch of 100-to-1 levered, hedge funds in a tiny little island nation tax haven are responsible for, like, if they go bust, if the basis trade ceases to exist, 40% of the demand would vanish for our debt. I think it's pretty stunning. And by the way, it was not just SOFR that was starting to become elevated. So SOFR is the secured overnight lending. Right now, about $3.2 trillion per day gets financed in that market. But also the unsecured lending market, overnight lending market, the interbank lending market, very, very similar concept. Except it's unsecured and it's much smaller. So Fed funds, when you hear Fed funds talked about and that sort of thing, Fed funds is the SOFR, but for the interbank unsecured overnight lending. That started to actually creep higher as well. So we can see that in white. Even the liquidity was so tight that not only were we seeing dislocation with SOFR, here you can see that, but the Fed funds also as well. And the Fed funds rate started to creep higher, and it didn't really quite approach the IORB, but it got pretty close.
Sorry, just the IORB. That's what exactly?
That's interest on reserve balance.
Gotcha.
So you can kind of see it in this chart. The white line here shows the effective Fed funds, and you can see that creeping higher. So the Fed was, I think it's kind of funny, the Fed was cutting interest rates, right, this whole time. But we actually saw the Fed funds moving higher, at least when you take a spread relative to the reverse repo award rate, which is the Fed's lower bound. That's the Fed, and we saw issues, by the way, on the other side. 2021 and liquidity was so abundant, so overabundant that we actually saw SOFR below the reverse repo award rate back here. That was 2019, by the way. That SOFR spike there. But yeah, in 2021, in 2022 even, we saw SOFR actually dipping below the reverse repo award rate. So it works both directions. The Fed can lose control over the cost of capital, the cost of overnight dollar lending. They can lose control in both directions. I think that caveat's important to be made. Right now what we're saying is there's liquidity is too scarce, and therefore SOFR has become elevated. And even Q3, Q4 breaking above and staying above the Fed's upper bound. So this is basically the Fed trying to control with a range what the actual cost of overnight loans, dollar loans is. With the upper bound being the discount window and the standing repo, they're the same interest rate. Right now, 3.75%. That's the Fed trying to guarantee that no matter what, no matter how scarce liquidity gets within the plumbing, the Fed is always there willing to provide some, dollars at 3.75%. And the reverse repo award rate, that is the Fed saying that no matter how overabundant dollars get within the plumbing, we will always come in, the Fed will always come in and guarantee to buy them from you at 3.5. That's what those two bounds are trying to do. They're trying to control SOFR. But what we saw was the Fed was losing control over the repo market. And we saw SOFR kind of, really start to blow out here. I mean, October was pretty wild.
Sorry, just to clarify, when you say lose control of SOFR, I'm watching that yellow line as the Fed, and I'm saying, hey, if there's a sustained spike that's in that yellow line, I'm concerned and I'm cutting rates. That's how I go about deflating.
Yeah, it's not a rate thing. So yeah, that's kind of what most people think. But cutting rates, I mean, we can see that they were cutting rates and it didn't make it better. Like for example, this rate cut here in late October, if anything, it made it worse. We saw even more, time elevated. Rate cuts really aren't the solution here. Liquidity is, and that's why eventually in December they announced the RMPs, because really the only way to solve what this is telling you, especially once you combine it with what we're looking at here, every green line here is when the standing repo was used over $1 billion, where over $1 billion was tapped from the Fed's emergency liquidity lifeline, the standing repo. Every single green line shows when over $1 billion was tapped. So you kind of look at it in totality, right? The standing repo never used, basically. My chart, I only did the green lines going back to like 2021, but this entire period of time, 2021, 2022, 23, 24, standing repo was like never used. And if it was, tiny, tiny little amounts for testing purposes and that sort of thing. And so we see SOFR start to blow out. Number one, indicating liquidity is short, is scarce. And then number two, you have an ever increasing frequency of, banks going to the Fed to tap the standing repo facility and tap liquidity because it was short. So you look at the whole picture, I think, and the only conclusion you can come to is that liquidity was becoming dollars liquidity was becoming too scarce relative to the demand for dollars, right? Because everything in these, when we were looking at this prior chart, like with SOFR, I think the best way to conceptualize it for normal people, imagine you're a bank on Wall Street. And imagine that tax deadline is coming up and, you guys, everyone's got to pay taxes and you were talking hundreds of billions of dollars. Well, you happen to plan ahead and you got $100 billion of dollars, actual liquid US dollars, cash, not physical cash, but cash. You're the only firm on Wall Street and everyone else needs cash. You get to charge them a really high price, right? If the demand for cash is extraordinarily high and the supply of cash is relatively minimal and you hold, the entire supply, you get to charge a very, very high price. Well, the price of money is the interest rate. That's SOFR. And it's not equally distributed, by the way. It's actually not one interest rate. There's a distribution. What we look at with those charts is the volume weighted median. But there's actually a wide distribution of what SOFR actually is, because we're talking, thousands, maybe even tens of thousands of individual repo transactions every single day. So you can look at the interest rate that was assessed, for each of those transactions, and then look at the distribution of it. And what we can see is that over the past 2 days, 25% of 3.2 trillion has been financed above the Fed's upper bound.
Wow. Yeah, no, that's crazy. Hold on. I just want to see if I can bring up that chart again. So the one question I did have is if they're using this repo facility on a continuous basis, that's not necessarily increasing the Fed's total balance sheet, right? Because if we look at the graph
Correct.
of the Fed's balance sheet, it's been going in one direction only, and that's down. So even though they're quote unquote, like this is not net money printing.
Well, so this correct. The SRF is not, but and remember, this is what a repo is. At the end of the day, the easiest way to think about what a repo is, it's a short-term asset swap, right? So I go to the Fed. I'm a bank. I need a bunch of cash. I'm short on cash. I go to the Fed. I give them $1 billion of U.S. Treasuries. They say, "Thank you very much for the collateral. Here's $1 billion." Well, the next day, I go back to the Fed, I pay them back, they give me my treasuries back. So it's a very, very short term asset swap or short term loan, overnight loan. That's the best way to think about it. So, yeah, the SRF is not really contributing. But what is the reserve management purchases, because the Fed is printing bank reserves out of thin air to buy those T-bills. So that is why the balance sheet has gone from looks like 6.54 trillion to 6.62 trillion recently, is because of the RMPs. The Fed is printing money to buy those T-bills.
Yeah, Joe, I want to bring it back to you because I mean your speciality, your niche is really Bitcoin. So I feel like I'd love to get your sense on how you're tracking all of this and how that falls within to your Bitcoin, let's say, framework. Are you doing all of this on a daily basis as a macro lightweight or heavyweight, however we want to classify you?
Yeah, I mean, so
what data points you're looking at to kind of inform that framework and update it?
For sure. Yeah, so as Robert noted, like this isn't a rates issue. The Fed can raise or lower rates all they want. It's whether or not, Fed funds and the other interest rates that they set in their sort of policy rate corridor, all they can do is try to influence the level of interest rates. Ultimately, they are set by the market. And so, this isn't a rates issue. When the Fed loses control of the repo market and repo rates, it's a liquidity issue. And ultimately, when the Fed winds up losing control, which chances are they will, given history as a pattern, you can look back to what they did in September 2019, right? What they did was sort of a stopgap measure with the reserve management purchases at a cadence of $40 billion per month. But that worked out for a little while. You could see that the repo rate was sort of, or SOFR rather, was staying close to that policy rate corridor, staying close to where Fed funds is. It's begun creeping higher in recent days. So it worked as a stopgap for a couple of months. Now they seem to be losing control again. And when that happens, chances are they're going to need to up the amount of RMPs that they're doing and then maybe throw it away entirely in the event that it goes away. Ultimately, all these operations are purchasing U.S. Treasuries. And so if it comes to a point where they lose control of SOFR to such a degree that they'll have to purchase U.S. Treasuries en masse, then that could be a much bigger liquidity injection, right? We're talking about a $40 billion per month cadence, but if they lose control of it entirely, you could see $100 billion a month purchases very easily. And so that is something that would be on the horizon and could be on the horizon in the event that they lose control of it entirely. And as we know, Bitcoin tends to be a pretty good barometer for liquidity, particularly during these short-term crisis events. It sells off to some degree, but then ultimately over time, it winds up correcting to the upside and reflecting that pretty well. So yeah, as far as my framework is concerned, that's one thing I'm watching. Infra is obviously an account that I follow. He puts out tremendous work on this. So on that front, he's sort of my quant, I suppose. But the key thing to be watching for is whether or not SOFR gets to such a point that the Fed loses control of it completely. It breaks out of their policy corridor for an extended period of time. And then following that, you would see the Fed announce an even larger program than RMPs. That would be a positive impact for Bitcoin in the medium term.
Yeah, I totally agree. I think it depends what happens over the next couple days, next couple weeks. But if we're starting to see liquidity stress return due to some of these really large T-bill settlements, and the fact that we're issuing more and more of our debt in T-bills, and having to roll that over constantly. If we start to see liquidity shortage again, we know what what their response is. We know it's to print money and then inject that into the financial system by buying U.S. Treasuries from the banks. So the reason this is called a liquidity injection, like the mechanism, is the buying of the assets from the banks, right? If you're a bank and you're short on cash, but you got a lot of U.S. Treasuries, and the Fed comes around and buys them from you, you just got freshly printed cash. So that's how it actually mechanically works. And we know that's their response to everything, is just print money. I mean, we saw the kind of gradual pace following 2019 and the repo rate crisis. We saw the gradual pace of money printing. Here we're looking at the balance sheet. The yellow line shows bank reserves. Looks like they went from about 1.35 trillion up to about 1.6. So 350 billion or so probably of money printed. But then, of course, 2020 came, and we saw what they are willing to do. So I think it all depends on the persistence and also the kind of velocity of some of the moves. I mean, here, for example, in late October, it was getting pretty concerning, the velocity of to which SOFR was starting to kind of dislocate. I think that velocity is one of the things that, I can't put myself in the mind of a Fed official, but I would imagine that persistence is another. So of course, if the velocity goes, if the thing goes to, 150, 250 basis points above Fed funds, that velocity, that huge, the large move there, that'll cause a reaction for sure. But outside of that happening, outside of a 2019 repo rate crisis where SOFR went like 11% above the Fed funds, outside of that, or 2%, 3%, something major. Outside of that, I think the persistence of it is really kind of what caused them to act. SOFR was becoming elevated above, and up, hanging out at and above the upper bound. And then it wasn't correcting, right? And it kept going above, and it would kind of stay above for a couple days. And again, the liquidity stress is not evenly distributed. 25%, 75% of SOFR, of the 3.2 trillion that was financed yesterday, 75% of it was below the Fed's upper bound. But 25% was above the Fed's upper bound. So, it's not, there is no like one liquidity measure, I guess. You can have liquidity stress that is not evenly distributed. And if I had to guess, the regional banks are, that hold a lot of maybe commercial real estate, maybe private credit exposed banks, who knows? But we don't really have, insight into exactly within here, who is who, who falls under what category. But, I would imagine the big banks are probably okay, but smaller ones, or ones that have exposure to, maybe some of these private credit issues, maybe regional banks that are heavily exposed to commercial real estate, their liquidity conditions might be a lot worse. So, we could see issues start to develop kind of in individual names rather than the entire banking system, because there is no one. We talk about one SOFR rate, but that's just the median of a ton of transactions.
Yep. So Joe, just to throw it back over to you, let's say, like, in your opinion, do you think Bitcoin has sniffed the bulk of this risk out? Because typically markets run 3 to 6 months ahead when it comes to pricing these kind of moves in. Is your gut reaction that the bulk of the Bitcoin correction, I don't know if you're a 4-year cycle proponent or not, but could also just be, time in the market. But is your gut that Bitcoin has sniffed out a lot of this potential risk on the macro front, and that's what's resulted in perhaps even an overcorrection, specifically relative to other assets like gold?
For sure. I mean, it certainly seems so. I'm going to go ahead and share my screen here. But I mean, this is largely, the move in Bitcoin isn't idiosyncratic. It's not happening in a vacuum. It's selling off alongside a number of other things. In my mind, the 4-year cycle is just one way of viewing Bitcoin's behavior. But this is just part of a broader risk sell-off that is, in all likelihood, as a result of this liquidity that's been tightening over the last couple of weeks and months. You can see here, this is the chart that I have up on screen. It's Bitcoin in the iShares software ETF. You can see that over the last year and some change, Bitcoin's been sort of following it to a T. So the sell-off in Bitcoin isn't really happening in a vacuum. It's happening in and amidst a broader risk-off move that's happening for some of the higher beta names, namely software, which obviously the sell-off there has a lot to do with the rise of Claude and other entities that are putting a lot of pressure on software stocks. Another thing that I'll showcase, I wanted to throw this up. This isn't a quantum-based sell-off. I think that's something that a lot of folks are talking about. And I actually got this chart here from Caleb Franzen at Cubic Analytics. If this was a quantum-based sell-off, a sell-off as a result of quantum fears for Bitcoin, then you would expect Bitcoin to be inversely correlated to quantum stocks, right? Quantum stocks would be soaring at the same time that Bitcoin is declining. But you can see here that Bitcoin and these two quantum stocks, IonQ and RGTI, topped on basically the exact same day. So what this tells me is that it's not a Bitcoin happening in a vacuum thing. It's not because of reflexive sort of baked into the price selling pressure as a result of the 4-year cycle. It's purely a risk-off move. And so then the question becomes like, looking to the downside, where could we see Bitcoin going and where could we potentially hammer out a bottom? Infra, I know you've talked about scaling your Bitcoin holdings up here. And buying over this most recent dip. But I do want to caution people, like Bitcoin tends to use the 200-week moving average as sort of a floor through market cycles. Obviously, there are a couple of other floors, the realized price being one of them, which also currently rests around $54,000. But that said, if you zoom out through like prior cycles here, Bitcoin tends to use the 200-week moving average as a pretty clean floor. You can see all the way back in 2015, we touched it, we based around for a little while, and then we launched back off of it after about 6 to 12 months. Same deal in 2019. We broke down below it very briefly for just 2 weeks in 2020, but we spent almost an entire year underneath it or around it back in 2022. In fact, at our lowest point, when we hammered out the bottom fully, we were trading at a 30% discount to the 200-week moving average. If that happened again today, then you would see a sort of terminal Bitcoin price for this cycle of about $40,000. That said, back in 2022, one of the main reasons that this occurred was because of the FTX collapse. Bitcoin had a decent amount of a good base that was built up here around the $20,000 level. And then FTX happened and we bottomed right around 16K. We fell an additional 25%. So that's not to say there isn't demand in this region. There certainly is, but the amount of time that's been spent between 60 and 70K is very low. If you take a look at the volume that's been spent for coins traded around this within this range. And so chances are we're going to hang out here before moving even lower. We just haven't spent enough time right down near that 200-week moving average to firmly say, okay, that's the bottom. Let's continue moving higher. Bitcoin has been pretty weak over the last 2 weeks, since February 5th, when we had that major sell-off from 70K all the way down to 59K, I think is where we touched very briefly. So yeah, I tend to think that Bitcoin's going to hang out here for quite some time. If you look at history as your guide, we tend to spend after going from the cycle top to the eventual bottom. There's an average of about 365 days, which is something that is a little bit unfortunate, but it isn't all that out of the ordinary. Last cycle, it was a little bit longer. So if you were to say like an absolute maximum amount of time that it would take Bitcoin to finally plant its flag and find its floor, you'd be looking at early October of this year. But judging by various on-chain indicators and cycles, excluding the prior one, which again had a lot of exogenous factors that caused its price to dip lower than historical norms, then you may be looking at like a May or June bottom. So that's not to say like we found our terminal price. I certainly think we have more room to move down to the bottom, and certainly a lot more time spent before we actually really hammer one out and begin moving higher.
I think that's a totally reasonable assessment. The one question I had for you was the exogenous factors in the previous cycle, let's say for like the FTX, was that something that occurred in the previous cycle in the must have been 2013, 2014 as well? Because it looks like, that was the only time where there was a considerable amount of time spent below that 200-week moving average, if we were to use that as a guide.
You're asking like in prior cycles, were there other exogenous factors that caused us to have massive sell-offs? Yeah,
I just think that there's some other kind of counter narratives that are suggesting that, hey, we could ping that 200-week moving average and bounce higher. And I'm kind of sympathetic to that view as well, just because FTX was, I don't want to call it an exogenous shock that might not occur again, but it very much was, if you look at the chart, one of the only periods of time that we went below and sustained it for more than a couple of weeks. All previous cycles that we've hit that 200 week, we've sustained at that level, if not bounced relatively quickly.
Yeah, I mean, this is just one indicator in and amidst like a slew of indicators that you could use, right? And if there's one thing that is absolutely certain in Bitcoin and markets more broadly, is that like you can't take anything as gospel. So like I wouldn't rule it out just because there aren't any major exogenous factors right now that could cause Bitcoin to drift lower. We won't really know. Like when Bitcoin tends to be at prices like this for a very long time, bodies start to float to the surface. You hear news about companies going under, halting consumer deposits, needing to liquidate their holdings, etc. So we're not quite there yet, right? As far as like there could be entities that completely blow up. We just don't know that yet. And I would wager a pretty high likelihood, or at least a few bodies floating to the surface. Whether or not that has a major impact on Bitcoin as a whole, and we see another capitulation event as a result of it, that remains to be seen. But you certainly can't rule it out, right? In the prior cycle too, like you can't really take narratives as gospel. One of the things that was said during the prior cycle was, Bitcoin has never fallen underneath its prior cycle's all-time high. And then all of a sudden we did, right? We went all the way down to 16K. And it happened again, right? Our prior cycle all-time high was $69,000. We are once again trading back down below it. So you can't really use that as gospel. Every cycle is different, and particularly for Bitcoin, which is just a 15-year asset, or a 16-year-old asset, rather, having a market price close to 17 years. You can't really use any one thing as your barometer for where we're going. You have to take all of these things in. You have to take all of these things into consideration. So yeah, all that is to say, like 200-week moving average is deep value territory. We could drift lower. We could spend some time underneath it. But if history is any guide, we may spend a couple of months around it and then ascend higher. Like May to October timeframe is sort of your high likelihood region for when we bottom.
Yeah, I think the best advice that I've heard is that you can't go wrong stacking down here and doing some kind of DCA if you don't want to do a lump sum purchase, because this is value territory. Whether it's deep value or value, it doesn't really matter. The point is, this is where you want to be buying, and it's much easier to time the bottoms than it is the top. And it certainly feels like I shared this article here just because this is one of those cyclical indicators that you look back and you're like, oh, that must have been close to the bottom. Here are some of the bodies that might start servicing. I'm not sure if this is a body just yet, but it definitely is one of those orange flags, we can call it, with suspending withdrawals. And it's obviously not as big as the FTX situation, but it's indicative of potentially of what could be a broader trend regarding bodies floating to the surface, as you alluded to.
Absolutely, yeah. It's a relatively small platform. Blockfills, they only did, I think, $60 billion or $70 billion in trading volume in 2025. So relative to some of the other major players in the space, it's not really something to be totally concerned about as a systemic risk. But yeah, this is sort of the bear market playbook. This is what you see on the way down. So it's no surprise to me.
Yeah. Rob, sorry, I don't know if you had, I saw you messing with some charts on
yeah, I was just looking as he was speaking at Bitcoin at prior cycles. Yeah, I don't know. I think that ultimately, like, the question of was it a good buy is what people, well, one particular person that likes to always comment on my posts. What you're missing is, like, I have a 10 to 20 year time horizon. So whether or not I get Bitcoin at 50 or 60 or 40, I don't care 10, 20 years from now when it's probably close to $1 million. Like I'm not buying this thing for, a 6-month appreciation for a short-term trade idea. I'm buying this thing as like a generational store of value, right, for the next 10, 20 years. Now, look, there eventually could come a point where it is smart to sell Bitcoin to buy dollars. I don't think that is anywhere close, and so therefore I'm going to, be holding this for a long, long time. I'm not going to trade it. I'm not going to use leverage, nothing like that. Well, I might, depending on, I might do like a 50% LTV sort of a loan, maybe in a couple months if the price structure is right and stuff, a conservative thing like that. But in general, I don't trade it on leverage. I'm not trying to like get in and out and catch every little move. And like, I don't care, I'm thinking 10, 20 years out where, there's a sovereign debt crisis all around the West and money is being printed that makes 2020 look like child's play. Like that's why I'm holding Bitcoin, for that eventuality over, I don't know exactly when it happens, but we know that we know what their response is to any hint of economic weakness, to any hint of financial stress. It's to print money. And so, yeah, then of course you add in the debt story and the fiscal picture of, again, not just the US, but basically every developed major economy outside of the ones that already had debt crises in the early 2010s, like Portugal, Italy, Ireland, Greece, and Spain. Outside of those developed economies, pretty much everyone else is in way too much debt, and their fiat currency is overvalued in real purchasing power terms. The real value of the debt must be devalued, and that's just kind of a mathematical certainty. Maybe productivity is allowed to or is able to get some of that done. I'm kind of skeptical. I think that the deflationary force of AI is going to come quickly. Like I went from, oh my God, you couldn't pay me to buy TLT to like pretty serious that I'm going to probably buy some TLT calls in the next week or so. Because I think the deflationary shock could come pretty quickly. And I think that we're already starting to see that with software companies. Then we saw it with wealth management. Charles Schwab was down like 18% in a couple days. So it's going to kind of like the Reaper meme. It's going to go through various different sectors, different industries, different companies, and start to kind of, that'll start to get priced into the equity market, which is a forward-looking instrument, right? Everyone that I talk to about AI, they're always like, well, yeah, but it's not there yet. And I think that the point that they're missing is the deflation doesn't have to come with, company XYZ is able to automate 80% of its workforce overnight and fire them, right? That's not really the first body. That's not the first shock. The first shock is the equity market looking at that company's future expected cash flow, going, "Oh boy, this company could be in some trouble. They could be replaced by an open source AI model, or whatever it may be, and discounting that and selling the stock down." We know how big of a driver the wealth effect has been for consumer consumption, consumer spending here in the US, which is the vast majority of our GDP, right? So if stocks start to stumble and you start to see like a prolonged sell-off in the stock market, which is forward-looking, then the wealth effect starts to go in reverse. Consumer spending starts to slow down. Once that starts to happen, right, it becomes a vicious cycle. You're talking about a recession. Well, what happens during a recession? Revenues go down because everyone's losing their job. Unemployment's going up. Everyone's losing their job. Capital gains tax is going down, right? Revenue for the government decreases on average by about 22% in a recession. Well, expenditures go up. As if that was not bad enough, the revenue going down, expenditures also go up due to automatic stabilizers. So on average, the deficit as a share of GDP goes up by 700 to 900 basis points in a recession. So we're talking in a recession, because of our insane pro-cyclical 6% of GDP deficit, we're talking a deficit as a share of GDP of like 15%. So I don't think the bond market would take too kindly to that, and I think they'd have to print and monetize a sizable portion of that.
I mean, Joe, over to you. I don't know if I've heard a better case for Bitcoin than that. Maybe Dalio's recent article could come close, but that was a brilliant.
Well, yeah, real quick. You add in the geopolitical stuff, right? You add in deglobalization, the fact that we have clearly seen peak globalization and we are headed in the other direction, the pendulum swing. You add those things in, and it's just like in my opinion, a no-brainer. Increasing authoritarianism and the ability to have decentralized. I mean, all of no matter where you look, in my opinion, the case is very, very bullish for Bitcoin. Like I was just talking kind of the purely economic, and monetary side, but like there are so many other use cases and bull cases for Bitcoin outside of that.
100%. Yeah. Even talking about AI agents as well, right? It's a small use case right now, but you see, folks who are spinning up their Claude bots, giving them wallets, and they're choosing to use either stable coins or the Lightning Network on Bitcoin, right? So as these things grow in popularity even more, people spin them up, they use them in lieu of employees. You need to give them access to funds, and there's no better money to be using than, 24/7, 365, instantly settlable money, right? Which is Bitcoin. So yeah, talking about the debt situation, not just here in the United States, like if we think we have it bad here in the United States, look at all of the other G20 nations, right? As far as their debt situation is concerned. And then beyond that, look at lesser developed nations. And it's a terrible fiscal outlook, not just in the United States, but all across the West and the East. You fold in geopolitical risk and the use case for scarce money, right? This absolutely scarce asset that also has no counterparty, right? That you can store in your head, that you can instantly settle across borders. Like gold used to serve that role during times of tremendous geopolitical tension. But Bitcoin today is much better suited to serve that role in an economy that is much more service-based, takes place to a large degree online. Bitcoin is that asset, right? So not if they print, when they print, folding all of these other factors into it, right? It's hard not to develop a bull case for Bitcoin in this environment. And,
yeah, I totally agree.
As Robert said, just to butt in one more time, it's like it's not a trade. This isn't it's not a 5-year trade. It's not a 10-year trade. This is a multi-decade trade. Buying Bitcoin, it won't matter all that much in the grand scheme of things. Buying your Bitcoin at $66,000 or buying it at $46,000 wherever we bought them. This is ultimately getting into the ground floor of what is going to be one of the major geopolitical macroeconomic shifts of our time, moving away from a fiat-based system into a harder currency.
It's protection against wealth debasement. And I think that you guys have both made a fantastic case for why it's so important and why it's so unique, really, and why everyone should have at least some exposure to it. So I do want to end it there. Sorry, Infra, I know you had wanted to chime in, but we are on time.
Sorry about that.
He's got too much alpha. We'll have to hop on again next Thursday to go. We only got to one of the 4 topics. But Joe, thanks so much for joining us. I really appreciate it. And as always, Infra, thanks for hopping on and dropping some alpha for our audience. We really appreciate it.
Yeah, thanks, guys.
Next week, everyone, guys. Have a good one and enjoy the rest of your day.